Hi, I'm Michael Ruger. I'm the managing partner of Greenbush Financial Group. Today we're going to be discussing how you use retirement accounts to use those funds as a down payment for a primary residence. So we'll be going over 401k options, Roth IRA options, traditional IRA options. Each account has different features, but in general, people are looking to access those funds without having to pay big taxes or penalties in the process. And depending on where you're taking the funds from, if you're planning to put the funds back, there's different tax ramifications and timing deadlines that you have to be aware of. So let's first look at the options within the 401k 403b world. So if you have one of these type of employer-sponsored plans, that plan may allow you to take loans against your vested balance in the plan. Now, this is an optional feature, which means some employers will allow loans and some don't. You really have to either read your summary plan description, which will detail that, or you can ask whoever handles your 401k at your company or organization, do we allow loans? So let's review how these loans actually work. So if the plan does allow loans, you can go in and say, okay, I've got a $50,000 vested balance in the plan. That makes me eligible for a $25,000 loan against my account balance. So you have some decisions you have to make as far as you get to choose the duration of the loan. So most 401k loans last anywhere from 1 to 5 years. However, certain plans will have a special provision that says if you're using it for the purchase of your primary residence, you can actually stretch the duration of that loan for the duration of the mortgage. So you could actually have a longer time period to pay it back, which means lower loan payments, which might be important because if you're taking out a mortgage for the first time, you might say, well, I don't have extra money to put $500 a month towards this 401k loan. So you'll get to choose really the payback schedule, which will determine what your loan payments are. Now, loan payments are made via payroll deduction. So once you've gotten the check for the $25,000, then those payments you'll see come directly out of your paycheck as scheduled until the loan is paid in full. Now, another question we get is there interest on the loan? Yes, there is interest charged for the loans, but for 401k loans, you're paying them back to yourself, so the interest goes back to your account. Now, the other question we'll get sometimes is, can I pay the loan back early if I want to? So I took out this $25,000 for the down payment, but I think I'll have the money in 2 or 3 years. Can I just pay it back in full? Most plans will allow you to do that. You can just write a personal check and pay that loan in full, and the money essentially goes back in your retirement account at that point. Now, the only downside to the loan is the money's out of the market. So as far as compounding interest, that money that you took out is not compounding interest until you're essentially paying it back. Now, there are caps. So I mentioned the 50%. But there's also a $50,000 limit on 401k loans, which means if you have a $200,000 balance in the plan, 50% of your balance is $100,000, but you're capped at taking $50,000, and that's an ERISA rule. So the most you can take is that 50 grand. So what's the tax impact of taking a loan from your retirement plan? So there's no immediate tax impact. I get that $25,000 loan. It's not like I have to pay ordinary income tax on that or any penalties in the year that I take it. However, as I make those loan payments back to the plan, I'm making them with after-tax dollars. Then when I pull that money out at retirement, I'm going to be taxing that money again. So again, it's almost a double taxation issue, but there's no immediate tax risk to doing this. Now, there's another option within 401k 403b plans called a hardship distribution. Now, this is also another optional distribution feature within the plan. Unlike a loan, this is not subject to payback, but definitely there's harsher taxation and penalties associated with hardship distributions. So if your plan allows these, you may be able to take all or a portion of your 401k out in the form of a hardship distribution, but in the year you take that money out, you not only pay ordinary income tax in that money, but you also pay a 10% early withdrawal penalty if you're under the age of 59 and a half. So again, if we look at that scenario where instead of taking a $25,000 loan, I now take a $25,000 hardship distribution, it's almost like you got $25,000 in your check that you haven't paid tax on. So when you go to file your taxes next year, they're going to say, we're going to take Fed and state income tax out, which could be, depending on your tax bracket, 30% plus. And on top of that, because you were under 59 and a half, we're also going to hit you with a 10% early withdrawal penalty, which now sends that 30% to 40%. So of that $25,000 I just took as a down payment for my loan, now I owe 40% of that come tax filing time in the form of taxes and penalties. Not usually the most ideal situation. So now let's switch gears over to your options with Roth IRAs. So if you have a Roth IRA, there may be features within that IRA that will allow you to take money out of it, tax and penalty free, to be used as a down payment on your primary residence. And the way this works is all the contributions that you made to that Roth IRA were made with after-tax dollars. And very few people realize that at any time in the future, you can always take your contributions back, tax and penalty free. It's the earnings piece that if you take it out before 59.5 that you pay the tax on. Because Roth are one of those accounts you put in after tax, it accumulates, and when you withdraw everything in retirement after age 59.5, you paid no tax on anything. But you can take out your contributions and then just leave the earnings so those keep accumulating, you don't pay tax or penalty. So example, over the course of the years, I put $20,000 into a Roth IRA. Now the Roth IRA is worth $40,000 because it's accumulated because of tax returns. Now I'm going to purchase a house. I can actually request, I want that $20,000 I contributed back out of the Roth IRA, leave the $20,000 that's the earnings to keep accumulating. And if I do that, I pay no taxes or penalty on that $20,000 withdrawal. Now, similar to the 401K method, I'm losing the compounding of that $20,000, and I can't just all of a sudden just put it back because I'm subject to contribution limits from there, but it could be a viable option. The last type of retirement account we're going to talk about is the traditional IRA or rollover IRA. So these are pre-tax IRAs that have never been taxed before. Now there's two options within traditional IRAs when you're purchasing real estate. So the first is for first-time home buyers only. You can actually take up to $10,000 out of a traditional IRA. You pay tax on it, ordinary federal and state income tax, but you don't pay the 10% penalty. So if I take out that 10 grand, come tax filing, similar to the hardship distribution, they're going to come looking for the Fed and state tax. So there's a tax liability you got to be aware of, but they don't make me pay that 10% early withdrawal penalty if I'm under the age of 59.5, which is a plus. The other strategy you can use from a traditional IRA is really a funding timing gap strategy. And what I mean by that is there is such a thing called a 60-day rollover rule, which means we will have clients sometimes that say, well, I'm supposed to be selling this house and buying the next house, but the closing dates aren't matching up. So now I need the down payment to buy the house before I'm getting the funds on the house I'm selling. So I really just need this cash for 30 days to kind of bridge the gap in the closings. One of the strategies you can use to help this is that traditional 60-day rollover rule, which says I can take any amount out of a traditional IRA, and then if I put it back in that IRA within 60 days, it's like it never happened. So what we'll have clients do is say, if you're definitely sure your house is going to be selling within that 60-day window, you take the distribution from your traditional IRA, you use that for your closing. Once your house sells, you then take the money from your house selling, put that back in the traditional IRA within 60 days, and it's wiped clean. So it's just a way to create some funds for yourself. Now you can only do one of those every 12 months. So if you've already done a 60-day rollover with an IRA, that option is available to you. Also, the IRS is not forgiving if you miss it by 1 or 2 days, the closing goes awry, like anything. If you miss that 60-day window and you put the money back after 60 days, it's like you took the distribution, full ordinary income, and if you're under the age of 59.5, the 10% early withdrawal penalty. I hope this was helpful. If you have any questions, please feel free to reach out to us at moneysmartboard.com. Thank you.